Hello, everyone. Thank you for joining us today for another edition of our webinar series on sustainable investing. Today, a discussion of trends in sustainable, responsible, and impact investing in the United States. I'm John Hale, Head of Sustainability Research at Morningstar, and as I'm sure most of you know, we have been active in this field for the past years. We came out with our Morningstar Sustainability Rating for funds in March, and certainly that was a response to the growing interest in sustainable, responsible, and impact investing, both here in the U.S. and globally. And at the same time, as I think is pointed out in the U.S. SIF Foundation Trends Report, that's our topic today, our rating perhaps added some velocity to that trend. For the past 20 years, the U.S. SIF Foundation has been documenting trends in the field and publishing reports on a biennial basis, which have served as a key source of information about sustainable investing and in particular about the amount of assets invested in the field. The 2016 Trends Report has just been published, and here today to discuss that report, we're pleased to have with us Lisa Wohl, the CEO of U.S. SIF, and Meg Voorhees, the Research Director at U.S. SIF. Lisa and Meg, thank you for being with us today.
Thank you for having us. Really appreciate it.
Lisa, let's start off with you. Tell us a little bit about U.S. SIF, what kind of organization it is, and what you do, and tell us about the Trends Report and the purpose of it.
Sure. So U.S. SIF is a membership organization in the United States for sustainable, responsible, and impact investing. Our main goal is to advance the practice of sustainable and impact investing in the U.S. We do that through research reports like the Trends Report, through policy, through networking and convenings, through education. We have a course on the fundamentals of sustainable and responsible investment, and through working in coalition with many other institutions in the broad sustainability space. The Trends Report is an incredibly important document because it measures the state of professionally managed assets in the United States that are looking at one or more, utilizing one or more strategies of sustainable and impact investing. And it looks at sort of what the existing trends are, what's new and interesting, and what looks like they're percolating trends and why that might be that way. It's the only kind of its report in the U.S. It is an evergreen report literally until the day before we put out the next report 2 years later. It also is a main lead into the global sustainable, the global group of SIF, the Global Sustainable Investment Alliance, which U.S. SIF is the secretariat of, and in the first quarter of next year, we will be publishing the global report on the state of the field, and that's also something that stays very evergreen until pretty much the day before the next report comes out. So we believe that this gives practitioners and prospective practitioners and other stakeholders incredibly important information, and we really enjoy it being utilized by our colleagues, our stakeholders, our members, and non-members.
Okay, great. And we have, I just noticed at the top of the slide, we have a kind of working definition of the field. So as we proceed over the next few minutes, I take it we can sort of use that as our jumping off point in terms of what is meant by sustainable, responsible impact investing.
Right, and what I would say, John, is we use the same sort of definition for all of those terms. It's been called social responsible. Now in the U.S. it's more routinely called sustainable, sometimes impact. Impact by some means largely private equity. We use it to be across all asset classes. So it's really how do you use environmental, social, and corporate governance criteria to generate long-term competitive returns and to achieve positive impact. And so we understand there's sometimes confusion in the field around words, but we believe it actually is very simple. How do you use investment to get a return and to drive social and environmental change?
Okay, great. Well, so Meg, let's go through some of the key findings here, starting with I guess this headline, 8.72 trillion.
Sure. So the 2016 Trends Report is taking a snapshot of U.S. domiciled assets that are engaged in sustainable, responsible, and impact investing strategies as of December 31st, 2015, so year-end 2015, opening of 2016. So what we found is that at the start of 2016, there was $8.1 trillion in U.S. domiciled assets that were held by 477 institutional asset owners, 300 money managers, and more than 1,000 community investing institutions that were applying ESG criteria, environmental social governance, and investment analysis. That's that large blue circle you see on the slide. In addition, we found $2.56 trillion in U.S. domiciled assets that were held by 225 institutional asset owners or money managers that filed or co-filed shareholder resolutions on ESG issues from 2014 through 2016. That's that smaller orange circle. As you can see, the circles overlap. So our net number, $8.72 trillion, is developed after we eliminate for double counting for assets that are involved in both strategies, the overlap between the orange and the blue circles, and also for assets that are managed by money managers on behalf of institutional investors. So we want to make sure we aren't double counting those assets. In 2016, as in previous editions, we asked money managers what portion of their ESG assets are managed for institutional clients, or we obtained this information through public filing. So we're careful not to count the institutional assets twice because we also survey institutional asset owners separately. So our overall number is $8.72 trillion as of the beginning of this year.
And so the smaller circle represents at least, I guess, a component of what's often called active ownership, documented here by investors that sponsor, co-sponsor shareholder resolutions. Now, why is that important? Why is that listed here as a component of?
Well, we think engagement is important across the board. There can be engagement in other asset classes, certainly private equity. There can be engagement apart from filing shareholder resolutions. We know that a number of investors meet with the managers of portfolio companies. They share their views. They write letters. But filing shareholder resolutions is at publicly traded companies is something that's very public, and it's fairly easy for us, the research team, to verify. So we have counted it for many years, and I would say that it reflects the idea that is common to, I think, most investors who are in this space, that there is no perfect company. You can use ESG incorporation and make some decisions about what companies to include in a portfolio, but probably many of those companies could still make further progress, and I think that's what's behind the idea of engagement, that you continue to work with companies to make them feel better.
Yeah. And so you have sort of, almost like three groups of investors here. You've ESG incorporation only, doing it only through their portfolios, right? And then some that are doing both portfolio level ESG and active ownership via shareholder resolutions. And then there's a sliver that are only doing shareholder resolutions. What is that about?
It could reflect just the nature of the asset owner. Some very large asset owners, such as public pension funds, may feel that across much of their holdings, they really have to invest in the overall economy. They don't, because they're so large, they can't really pick and choose that much among individual companies or holdings, and so that's where the shareholder engagement comes in. But it can just really vary very much by institutions and money managers and what their focus is.
Yeah.
The money managers that are involved in shareholder engagement are often doing it as a service to their clients, and it's part of their mission. So we see a lot of the money managers that have been trailblazers or pioneers in sustainable investing also practicing shareholder engagement by helping their clients file shareholder resolutions.
Mm-hmm. Okay, and this slide really now tells us about the continued growth in the field.
Okay, I think that's our next slide, which I'm not seeing just yet.
Okay.
But while we wait for that slide to show up, yes, the big story, in addition to our overall number, is, what does that overall number mean, the $8.72 trillion? It represents 33% growth since our last survey in 2014, and it shows the field has grown more than 14 times since 1995 when we first started surveying sustainable, responsible, and impact investing in the United States. The other intriguing factor is that sustainable investing has been growing in relative terms in market share as well as absolute terms. So sustainable investing now represents 22% of all U.S. domiciled assets under professional management, and that's up from 18% in 2014.
So there's a big jump in.
And now I'm seeing the slide there that shows the growth since 1995.
Right. You see the big jump between 2012 and 2014, and then another pretty significant jump with this year's report.
That's correct.
Yeah. Tell us just a little bit about how you collect the data for this and how it's been done over time. You mentioned that it's year-end 2015, so you go back 2 years basically with each report.
Correct, and so our research process probably begins in about February of each year. So this year we start doing some preliminary research and updating our database, which tracks about 2,000 institutions, institutional asset owners, and money managers. In March and April, we start sending out the survey to all of these folks if we have contact information for them. We, in addition to waiting for responses to come into the survey, we also do secondary research. So we are going to the institution's websites. We are looking at their money managers' filings, nonprofit institutions, 990 forms, a whole host of reports and forms to get basic information. But we get a pretty good response rate, I would say, of the 300 money managers we cover. About 100 or 105 reported directly to our survey, and of the 477 institutional investors, we probably heard from about almost 100 directly. So that's not bad, but then it's hard work for the research team. We have to fill in those gaps and do quite a bit of research on the side.
Mm-hmm. Well, let's delve into this a little more about the growth driven by asset managers. On the next slide, as we've already pointed out, huge jumps between 2012 and 2014, and again to 2016. What's driving asset managers to incorporate ESG criteria?
Right, there has been a huge jump, and when we look at this increase from 2014 to 2016, it is the largest trend there is the growing interest of asset managers in considering environmental, social, or corporate governance criteria in investment analysis or portfolio selection. So we identified $8.1 trillion in money manager assets that take into account ESG factors, and that's up 69% from the $4.8 trillion we discovered among this group in 2014. And the basic reason is client demand, as we'll see in some of the subsequent slides we look at. And I think money managers are responding to demand both from institutional investors, as we see on this slide, and also from retail investors. They are encountering demand or expecting increased demand from the retail market. So here we can see on this slide that institutional asset owners that practice ESG incorporation has increased over the years, and we saw a sizable increase from 2014 to 2016. So institutional investors account for $4.7 trillion in ESG assets.
So while demand continues to grow among institutional asset owners, it doesn't account for the total growth we saw on the previous slide, right? I mean, we still have a number of asset managers also increasing their commitment to ESG independent of the...
Yes, that's correct. In fact, when we surveyed money managers and asked about what portion of their assets were institutional, we came up with a somewhat larger number than what we heard of from the institutional investors directly. So when we surveyed money managers, they said that about $5.1 trillion of these their assets were for institutional clients. So, the implication is that probably nearly $3 trillion of those, the money manager assets, are for the retail investor market. So this slide provides a little more detail on what's driving the growth in ESG investing. So as I mentioned, for asset managers, the primary motivation at the top of the list is to meet client demand. And then it's interesting that both asset managers and institutional asset owners, you see very large majorities of the institutions and money managers responding to this question saying that they practice ESG strategies and filing shareholder resolutions to help fulfill their mission, to manage risk, to generate social benefit. Money managers also say they are looking to help improve returns and also to meet fiduciary duty.
Let's discuss fiduciary duty just for a second here, because it seems like we've seen this idea kind of sort of turned around. I think fiduciary duty used to be used at least as a reason or maybe an excuse to stay away from sustainable or responsible investing. But today there seems to be a realization, at least according to these numbers, that fiduciary duty is an important consideration in actually incorporating ESG.
That's correct, and I think if you look at all the motivations, you can see that fiduciary duty in part is recognizing that looking at ESG criteria can help in managing risk, can help in improving returns. And I think if you are also a fiduciary for a nonprofit, a foundation that has a social mission, helping to fulfill that mission or making sure that the investments don't contradict the institution's mission can also be a part of fiduciary duty. I think the reason that percentage-wise that fiduciary duty as a reason lags behind is that until recently there was some confusion for fiduciaries of private sector retirement plans about the extent to which they were allowed to look at sustainable investing options or to consider ESG criteria. That there was guidance from the Department of Labor stemming from 2008 that was very confusing. And the Department of Labor issued updated guidance last year about this time, 2015. And so we are expecting to see private sector retirement plans probably feeling more empowered or free to move forward on the ESG sustainable investing front if they so choose.
Yeah. All right, let's delve into this idea of ESG incorporation by asset managers.
Okay, so on this slide, in the large green portion of the pie there, so we're delving into the money managers at $8.1 trillion. So in the large green portion of the pie to the left there, those represent the money managers that didn't provide a count of the investment vehicles or funds affected. We know that included in that green portion are some mutual funds, some variable annuities, separate account strategies, and other vehicles, but we could not get a precise count. On the blue side of that circle, this represents money manager ESG assets where we did get fairly precise counts of the funds and vehicles involved. So if we look at the that blue, if you move to the right side of the screen, you will see a breakdown of that blue portion of the pie. So we have 475 mutual funds and 413 alternative funds. By alternative funds, we are referring to property and real estate funds, venture capital and private equity funds, and hedge funds. And finally, the very small orange sliver in the circle to the left represents the $122 billion held in assets by more than 1,000 community investing institutions. These are banks, credits, loan funds, and venture capital funds with a specific mission of assisting low and moderate income communities. The majority are focused on U.S. communities, but we also include some U.S.-based microfinance funds that provide assistance to low-income communities or borrowers overseas.
Okay, so the green, the assets depicted in green in the circle there are sort of unidentified as to the specificity of the vehicle. Is that right? Yes.
In some cases, we identified a number of large money managers who did not respond to the U.S. SIF Foundation survey, or they did not respond completely, but they did file reports because they are signatories to the Principles for Responsible Investment. And those transparency reports are called, ask respondents to provide total assets and descriptions of ESG investment policies, but do not require the filers to disaggregate their assets by vehicle type. So in some cases, yeah, we identified assets that were considering ESG criteria, but we couldn't get more specific about the numbers or types of investment vehicles involved.
So I thought this was a helpful depiction of the various ways that ESG is incorporated into an investment process. It seems to me like the field is considerably more, complex and multifaceted than it used to be when it seemed like negative and exclusionary screening was dominant. But this is when you're talking about sort of ESG incorporation, these are the various ways, correct, that an asset manager might actually do that.
Yes, that is correct. So we, in the survey, we made clear here are some of the ways in which we think you can practice ESG incorporation, because we don't want to. I think in the past, people who have said, oh, well, sustainable investing is negative screening. We want to make sure that people understand it's a wide range of strategies, but what they have in common is they're considering environmental, social, and governance criteria.
So where are we headed with this? Do you get any sense of that from the report? I mean, are we headed more towards ESG integration as a technique, or impact, or is screening changing?
Yes, I would say, and I'm happy to invite Lisa to weigh in here as well, I would say that ESG integration, that third option we're discussing here on this slide, has been definitely rising over the last 4 years, and particularly among money managers. But I would say exclusionary screening is still pretty important when we look at the overall assets affected. In fact, let me see if I can just find my notes here, but 100 of the 300 money managers we cover in this study provided some background on the on which strategies they use, and 62 money managers said that they practice exclusionary screening and ESG integration. But the ESG integration seems to affect a broader portion of assets, about 1.5 trillion among these 62 managers responding yes to that question, compared with about $900 billion for negative screening.
Okay, let's go to this next slide because it's sort of touching on some of that topic there.
Yeah, so we look at 4 broad categories of ESG criteria: environment, social, governance, and the products line is probably refers quite a bit to the exclusionary screening. These would be, this would be consideration of products that are considered to be harmful or inadvisable in portfolios. So, for instance, tobacco would be a common product that sustainable investors would screen out of a portfolio or restrict their investment in. So that's what we're looking at there. So some of the factors would be tobacco, as I mentioned, alcohol, sometimes a screen, weapons, gambling have often been products or sectors that are excluded from portfolios.
Okay, and so on this next slide, you have some leading criteria that was identified by your respondents.
Right. So these are for asset managers. I just think this is very interesting that we're just seeing almost just much richer consideration of ESG criteria when we look at the specific criteria that are being considered. So starting kind of at the right and working to the left, conflict risk is the leading specific factor that money managers report considering. In many cases, this means that money managers are screening out or restricting investments in companies that are doing business in Sudan or Iran or other countries that are considered to be sponsors of terrorism or especially repressive to their own populations. Climate change and carbon risk has moved up the charts significantly since 2014, and it's in a close second place behind conflict risk now, considered by money managers, so affecting 1.4 trillion. So you can see it's more than doubled since in asset-weighted terms, since we looked at this in 2014. And then human rights, pollution and toxic, and board issues have also become much more broadly considered by money managers across assets since 2014.
Okay. So let's dig into the mutual fund side of things, Meg. What do we see? What are we seeing here?
All right. Well, we are seeing continued growth, not as explosive from 2014 to 2016 as we saw from 2010 to 2012 and from 2012 to 2014. This might represent sort of a natural leveling off and consolidation after such explosive growth over the previous 4 years. But it could also be that there are some mutual funds we weren't able to specifically identify or count. Remember when we looked at that slide where we talked about the green portion of the circle? for instance, one of the money managers that filed a transparency report to Principles for Responsible Investment is Franklin Templeton. We know it's a mutual fund manager. Franklin Templeton reported that it does ESG integration across a broad swath of its assets, but we weren't able to, from that statement, that report, identify how many mutual funds were affected. So I think our 2016 number there could understate to some extent the numbers and the assets of mutual funds today that are looking at ESG factors. Mm-hmm. And similarly, in the variable annuities, I'm not sure that there is actually a drop in variable annuities that consider ESG factors. I know that in 2016, one large money manager that operates a number of variable annuities did not give us a count this year as it had in previous years. So that is part of the drop there.
All right, let's move to this next slide, because I think it kind of addresses some of the issues with understanding the mutual fund number. And so it seems like we've got, a couple of things going on with funds and with, I guess, maybe even with asset managers in general, and that is, especially as it relates to ESG integration. So, it seems like to me it's very possible that a number of asset managers out there are, incorporating ESG into their investment process through integration, meaning they're availing themselves of the kinds of ESG company-level research that's now widely available, incorporating that into a process because it's, kind of a new and different set of non-financial information that could be helpful to them as they evaluate companies. But they're not necessarily aiming to create portfolios or an end strategy that delivers as a kind of outcome to investors a sustainable fund. Or, you know what I mean? It's not. So are both of those things going on?
Right. So in this chart, we would be counting not only the mutual funds that identify themselves as sustainable investing or green or socially responsible, but also mutual funds that don't advertise themselves in that way, but do say publicly that they, or in response to our survey, that they consider environmental, social, and governance issues. And one thing we're finding, which you can see here in this chart to a certain extent, is that a number of the money managers that report that they are doing ESG integration don't tell us a whole lot more after that. So all we can say is they appear to be considering general environmental factors or general governance or general social factors, but we don't know specifically which factors.
Right.
With the numbers of, yes.
I just wanted to jump in here. So, John, this goes back in a way to slide 9, which you had asked the question about, what do you see as a big trend line here? And one of the questions really is, I think, with ESG integration and the notion that funds are looking broadly at ESG issues. And, in fact, if you look at our report, it shows that, money managers have nearly $7 trillion in assets in environmental, social, governance issues, but without providing further detail. This is an area USCIF is very focused on. Our strategic plan really has talked about trying to get more accountability and transparency around those broad but undisclosed ESG issue integration. And we think it's going to be really important for the further growth of the field that more information is made available to investors on what these ESG criteria are. So we see it both as a great opportunity for the field, and it really shows the incredible demand, but it also could be challenging if firms don't disclose more kind of the E, S, and G issues that they're looking at. So it's very related to this slide and what Meg was talking about as well. It's just a small cut at it.
Yeah, no, it's very interesting. And one area too that I just want to touch on, because we didn't really we haven't really done so, because you related it back to slide 9, the different approaches, is this positive best-in-class approach, which to me is something that is sometimes like what's the line between that and ESG integration, I think is maybe not as well understood and maybe not consistently understood across asset managers, so it's difficult to figure out who's doing what. But that's a little bit different of a concept, I guess you would say, than just than general ESG integration.
Yeah, I think the lines are blurring a bit between positive screening and ESG integration, and I feel we're seeing less and less, fewer and fewer institutions and money managers saying they're doing positive screening versus ESG integration. So, yeah.
All right, well, let's talk for a minute about community investing. Meg, you mentioned it in passing earlier. It's a rather small portion of the ESG assets under management, but I think all three of us in talking about this ahead of time felt it was important to certainly mention community investing institutions and their role in this field.
Yes. So I can touch upon the growth a little bit, and Lisa, I think you have some thoughts about the social significance, especially these days, of community investing. But yes, we saw a very large jump in assets of these community investing institutions from 2014 to 2016. And the rapid growth is the result of a number of reasons. One is that more than 100 community banks and credit unions became newly certified or recertified as community development financial institutions under a U.S. Treasury program. And community development credit unions in particular experienced increased membership and growth in assets within this sector. In addition, we're seeing that new online platforms such as Mission Markets, there's a vested.org platform from Calvert Foundation. They've helped to lower barriers of entry for investors who are seeking opportunities to support community development institutions and community investing generally. So maybe there are now platforms that make it a little easier for investors to find community investing projects.
Yeah, and I'll just add a couple words to that, which is, you know, it's interesting right now, post-election, there's a lot of conversation about underserved communities in the United States, whether it's rural or urban. We, of course, I think all are seeing what's happening at Standing Rock, and, you know, there are community investing institutions, credit unions, and community banks, loan funds across Indian country, Native Americans, American Indians, Native Alaskans, Native Hawaiians. And, you know, what's interesting about community investing is you can pretty much find a community investing institution in every state and in every congressional district, and I think they investors will be paying increasing attention to them as they think about how they want to invest over the next few years, I think, and make impacts in communities that oftentimes are at risk of predatory loans and poor housing, inadequate social services, et cetera. And so I would not be surprised if the community investing world gets greater attention over the next 2 years rather than less.
And so how does an investor typically access a community investment?
Yeah, it could be through deposits in credit unions and banks that have a community development mission. It could be investment, and some of those banks and credit unions have more specialized funds that for investors to look at, and we also have some venture capital funds and loan funds with a community mission. So those would probably be more limited to high net worth, you know, accredited investors. But there are also some loan funds that are available to retail investors that, you know, offer note options that retail investors can take advantage of.
Okay, let's turn our attention here towards the end. And folks in the audience, if you're thinking of questions, we'll turn to questions in about 3 or 4 minutes. But let's talk here a little bit, Meg and Lisa, about shareholder resolutions and what you found in the report.
Okay, so at the opening of our remarks, we mentioned that there were about 225 institutional investors and money managers that filed shareholder resolutions on ESG issues over the last few years, and this pie chart just shows how they are divided up in terms of the numbers of institutions. So faith-based institutions have been numerous as shareholder advocates, very active in this space. As I mentioned earlier, also money managers, particularly money managers associated with sustainable investment firms, have filed a lot of resolutions. But some other sectors that are important are public funds, foundations, we see labor unions, and other nonprofits also being involved in this field.
Mm-hmm. And then some of the key issues.
Yeah, so this is focusing on the environmental and social issues, and we'll have another slide that looks at some of the governance issues. But over the last 3 years, probably the leading concern just in terms of the numbers of proposals filed have been concerning investor demands for disclosure and oversight of corporate political spending and lobbying. And basically, shareholders want companies to exercise proper oversight to ensure that these payments serve the best interests of the firms and their shareholders, and that their association with their membership in trade associations or lobbying is not contradicting their publicly stated policies on issues such as climate change. So many of the targets of these political spending and lobbying contributions were at companies that pay dues, make contributions to, or sit on the boards of organizations that have opposed the legislation to curb greenhouse gas emissions. And we also see that climate change in its own right has been a leading issue as well. A lot of those proposals are asking companies to reduce their greenhouse gas emissions, to use more renewable energy, to control emissions of methane, which is a very potent greenhouse gas. And some of the fossil fuel companies have asked to report on stranded assets, the assumption that they will not be able to pump all of their reserves out of the ground. So those are some of the leading issues there. Sustainability reporting, other environmental issues are also pretty important. In terms of governance issues, I would draw your attention to the fourth line. The big story has been the campaign around proxy access. So basically, historically, the board elections of publicly traded companies have almost never been competitive. Shareholders are presented with a single slate of candidates approved by the company's nominating committee. And if shareholders wanted to propose alternative candidates, they had to send out their own alternative proxy ballots, which is very expensive. So the Dodd-Frank Act in 2010 gave authority to the SEC to implement a rule to allow shareholders under some conditions to nominate directors to the boards and have access to the company's proxy materials to talk about those candidates. The SEC issued a proxy access rule, but business groups challenged it in court, and the SEC chose to withdraw the rule and never came up with a new rule. So that was the situation as of 2015 when the New York City Comptroller, Scott Stringer, spearheaded a major proxy access campaign. He filed numerous proposals on behalf of the city's pension funds that asked target companies to present a proxy access bylaw to shareholders for approval that would allow shareholders that have collectively owned 3% of the company's stock for at least 3 years to nominate alternative candidates for up to a quarter of the board seats. So over the course of 2015 and 2016, you can see that more than 300 proxy access proposals were filed, and they collectively did quite well. I mean, the majority received majority support. And we probably can't do justice in the space of one slide to success stories from these various shareholder campaigns, but we can, just a few highlights. Many of the proponents were able to withdraw proposals on the corporate political lobbying issue in exchange for substantive commitments from target companies. Numerous companies made progress on curbing greenhouse gas emissions or making commitments to do so. CLARCOR agreed to issue a sustainability report after a proposal earned 61% support, and many other companies also stepped up their disclosure. On the proxy access campaign, I think interesting statistic is that in 2014, fewer than 1% of the S&P 500 companies had a proxy access provision. By the end of 2016, with the shareholder campaign, the percentage was 40%. So we went from 1 to 40% of the S&P 500 companies over a period of 2 or 3 years as a result of this proxy access campaign.
And sustainability reporting also has increased by a lot over the years, partly.
Yes, I don't have statistics, but yes, there's been a dramatic increase in the number of companies that file sustainability reports over the last decade.
Right, and just quickly to end this, because people may not all realize, but a withdrawn proposal is often a sign of success.
Yes, that's correct. So proposals can be effective even if we all never see them in the final proxy statement that the company issues.
Right. Okay. Well, let's kind of wrap up the presentation part, and if we can get ready to go to questions. I just want to say, that in summation here, clearly the field continues to grow, both in terms of the development of intentional ESG strategies and approaches, but also in terms of conventional asset managers incorporating ESG into the process. Let's sum up if you all have, Lisa and Meg, any kind of concluding comments about where you think the field is headed.
Right, and then we can go to some questions. So I think the field is in a really interesting place right now. I think there are more and more ways that investors are accessing the field, and what I mean by that is we, for example, did some How Do I SRI guides about 18 months ago, one on climate, one on women, and one on political contributions. And so what you'll see is you have a lot of investors concerned about climate. That comes really clear through this report. You've got a lot of investors increasingly interested in gender lens investing, which is still very, very small, but all of a sudden in the last couple of years has kind of grown up. Sustainable ag is something that brings people to the field. And so what you're seeing is not necessarily that investors from retail to institutional are saying, I really want to be an ESG investor, but they may be brought in by one issue and it kind of explodes into a broader range of areas of concern. So I think that's really interesting. We also know that more and more client-facing professionals want to be expert in this or knowledgeable so that they can retain clients who are increasingly interested in this. And so, for example, Morningstar is going to host our course on May 11th in Chicago, our fundamentals course during the USF conference, where we train client-facing professionals on SRI. I think we're going to see a lot more advisors and consultants who really want to be trained and educated so that they can keep the clients who want this. So I think those are all really interesting kinds of trends. I also know in our own membership, we've gone from, in the 10 years that I've been here, a lot of original SRI shops, SRI only, to much more conventional institutions where, somewhere between 5 to 50 people in that multi-thousand institution are focusing on sustainable and impact investing. So the field, I think, is at a real pivot point, and I think the next 10 years are going to be a really interesting time, both in terms of growth and in terms of sort of the various strategies that are used to address ESG issues.
Okay, operator, we will go to questions now.
Thank you. At this time, we would like to begin the question and answer session of the conference. To ask a question, please press star followed by the number 1, unmute your phone, and record your name at the prompt. You must record your name clearly for your question to be introduced. To cancel your questions, you may press star followed by the number 2. One moment to see if we have questions.
Okay, while you're waiting, I might take John, I don't know if you want us to do the questions, but I see several questions here. Meg, one question was, can you explain the 2 different ESG stats? 3 states 8.1 trillion ESG incorporation, where S4 shows 6 trillion ESG incorporated only. Did you answer that already? There's S3 and S4.
Okay, I don't think I see a contradiction. Slide 3 was looking at the overall growth. The total growth is the total sustainable investing field is $8.72 trillion, of which $8.1 trillion is ESG incorporation. And then on slide 4, we're showing the growth over time. And we're showing that the 2016 figure represents 33% growth since 2014.
Right. And I think what they're looking at is the ESG incorporation only piece of that. So that explains that.
Yeah.
Please define what you mean by institutional investor.
Okay, institutional investors, these are institutional asset owners. So they would include public pension funds, foundations, educational institutions, faith-based investors. Those would be the labor funds. Those would be the major categories. So the institutions that own assets that are looking at ESG criteria or filing shareholder resolutions.
And there's a question with the increased focus, is it possible that USCIF will ever move to producing the trends report on an annual basis? We get asked this all the time, and I think it would take a tripling of our research staff and our budget in order to do that. It is one of those reports that kind of takes up all the space in an organization for about half a year. So we love it, but I think for right now we're going to be at every 2 years.
We have a question over the phone. Are you ready to take the question?
Sure.
The first question comes from Devine Investments. Your line is now open.
Hey, good afternoon. Thank you for this wonderful webcast today. I was wondering if you had any information on ESG and impact investing by asset class. So how investors are choosing to invest in ESG and impact in equity space or fixed income space or in other asset class or security types.
We have partial answers to that question on asset class. We have information in the money manager space. We identify alternative funds, and we look at private equity versus hedge funds versus property funds and have some assets and counts for each of those categories. In mutual funds and some of the other investment vehicles, we don't have a breakdown by asset class. So we, don't have a subdivision of mutual funds by whether they're fixed income or equity and so forth. If you purchase the entire trends report, there is a list of mutual funds and ETFs, and you can probably determine by looking them up or looking at their names and what the asset class is. But the trends report does not specifically focus on asset class.
Right. Do you get the impression from your familiarity with the different investment approaches that the asset owners are implementing an ESG and impact strategy in a particular asset class? So is it really common in equities but not in fixed income? Is it really common in real estate but not in other sorts of private vehicles?
Yeah, I would say, historically, the focus was first in the equity space and public equities, but now increasingly we're seeing ESG impact investing practiced across all asset classes. There are a lot of fixed income solutions and managers that are looking at ESG and sustainability issues. I don't know as a percentage of the various asset classes, like what percentage of property funds are looking at ESG issues or what percentage of alternative private equity funds, but I do know that across all those different asset classes, you do see some vibrant ESG investing.
Thank you.
Is there 4 people in the room with you?
Other questions?
We have another. Yes, we have another question in queue. He was not able to record his name. However, if you still have a question, sir, your line is now open.
Okay, I don't hear anyone, so I see a question about talking about the standardization of being considered an ESG investor and how this has evolved over time, which focuses on asset managers that may claim to integrate ESG characteristics, however may only be doing this as a marketing play. I referred to that a little bit in discussing the sort of undesignated $7 trillion. And what I'd say is that there's no doubt that more and more firms are going into this, both because of interest among the firm itself, but because of demand by clients. And I don't have any evidence to say that folks are marketing their fund as an ESG or an SRI fund and doing nothing. I do know that there's been increasing concern that, for example, PRI signatories are doing something, and so the recent decision by the Principles for Responsible Investment to start delisting over the next several years signatories who actually cannot show credible proof that they're actually considering ESG issues. We applaud that, and our sister organizations around the world applaud that, because we believe that, getting everybody on the same page of doing something critical when they say they're looking at ESG characteristics or doing sustainable investment is really important. And so that's something we're going to be very focused on the next 3 years. And as again, I do think it's both an opportunity because we want more and more firms to take this on, and a challenge to make sure it's being taken on in a meaningful and kind of strategic way. Do you have any other questions on the phone?
There are no questions in queue at this time. Again, as a reminder, to ask a question, please press *1 on your phone and record your name. One moment, please.
Okay. We have another question. How has the number of respondents to your survey increased over time? And do you know how many additional respondents we've had this year versus 2014?
I think I may have to follow up with an email on that question, but I do think our response rate has maybe been inching up over the last few years. I think the survey is getting better known, sustainable investing is getting better known, money managers are more interested in being seen as active in the space and are more willing to participate.
Any more questions in queue, operator?
Yes, our next question comes from Brian. Your line is now open.
Hi there, it's Brian Brumley in Portland, Oregon with Progressive Asset Management, and thanks again for this call and the report. And Lisa, it was good to see you out in Denver not too long ago. My question involves who is doing the investing here? Is there any demographic data on the age of folks who are looking for ESG criteria or the income or relative net worth of these people?
Well, this is, we're looking at sustainable investing representing about 22% of the overall investment market. So it's probably, I would say it's a very diverse group. If you're asking about the retail side or, you know, who are the individuals who are involved, I have seen some interesting surveys that talk about, you know, the interest of the millennial generation. There's more interest than, you know, their older cohorts in sustainable investing and making a social impact with investments. I've also seen surveys that say women are particularly more interested than men generally. But I think as sustainable investing becomes a broader part of the market, I think we have to assume that it's going to be a broader demographic that's interested in sustainable investing or in ESG investing.
Thank you.
Our next question comes from Barry Graywall. Your line is now open.
Hi, thank you for this information, very informative. I was fortunate enough to attend a couple conferences on sustainable investing. I just wanted to know, is there tracking on, I understand there is some on climate change, but as far as companies that are working to reduce waste or their supply chain sustainability, Starbucks, for example, is there any tracking on what companies are planning to reduce their waste or reducing their reliance on natural resources and recycling more, or is that just found in the sustainability report?
How companies are performing on environmental measures, such as the ones you're mentioning, are beyond the scope of the Trends report, but it's certainly something that many of our members, the USIF members, are assessing. You know, our members include research firms that specialize in assessing companies on environmental, social, and governance indicators. Morningstar is partnering with one of those firms in developing ESG ratings for funds based on the kind of ESG characteristics of underlying portfolio companies. You know, a number of our asset manager members are assessing companies, have their own you know, systems for assessing companies. So they would have probably have a lot to say to you, but I don't, as, you know, co-author of the Trends report.
I'd also recommend, for those of you on the call, we have a lot of research at www.ussif.org in our Center for Sustainable Investment Education. One is called the Impact of Sustainable and Responsible Investing, and it goes into, it's a much less quantitative report, it's a more qualitative report about why this field has made a difference, how it's made a difference, both on kind of what I call the investment supply and demand chain, but also on policy and on standard-setting organizations. It has a timeline. It gets into much more around the kinds of shareholder issues that have been worked on and how they've been successful. So the last question prompted me on that, because I think many of you on this call would find it a really interesting report. You'd also, if you have clients or work with clients, might be very interested in our How Do I SRI handbooks. Those of you who work with foundations, we have a report on foundations and another one on family offices. So I just recommend that you take a look at our website. Virtually all of our reports are free to the public except for the Trends report. So anyway, John, I know you're going to wrap up, but I really want to thank you on behalf of USIF for everything that Morningstar is doing to move the ESG needle forward, but also your work with us and for holding this webinar today, and to the team that you have at Morningstar who've worked on this as well. Really appreciate that.
Yeah, well,
and to Meg and the team here who have put so much time and energy into producing this wonderful report.
Well, thank you both for being with us today, and for all attendees, thank you for joining us. We'll also be distributing the slides subsequently to this, so you'll have those. Watch your inbox for that. So that's going to wrap things up. Sorry we went a little over, but again, thanks for joining us.